Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, 9 a.m. Eastern, every Monday morning. Get you ready for the week. Got a great topic for you this week. Of course, the markets have started falling once again. A lot of investors worried, wondering when it's going to stop and how to take advantage of this. That's what we're going to talk about today. Going to talk about my strategy, how far stocks could go, got some numbers behind that, and everything you need to know with a strategy that's not only going to help you take advantage of these lower prices, but take some of the risk out of your investing as well. So going to do that. Stick around after that though, because we've got our Monday market updates with the stocks I'm highlighting, the economic news this week that you need to know about. Before that, I do want to highlight a special program. We just started this last week. Been planning this for a long time, but if you've ever wondered what stocks I'm going to talk about before those videos come out, if you've ever wanted to see the stocks I'm buying or selling as they happen, just started the Bowtie Nation community here on the channel. Going to leave a link to that in the description and the comments below. Check that out. You're going to see all these extra perks, insider access that you're going to get. You can get things like custom emojis on the comments and the live chat. You're going to get special priority reply to the comments. I'm going to reply to all the member comments first. You're going to get the portfolio tracker spreadsheet, which alone is a $35 value. You can get access to members only live streams. You can get real-time notifications as I buy and sell stocks and a lot more. So go ahead and click through that link below. Check that out. On to today's topic though, because I see the stress level rising in a lot of investors here. Market is now down about 5% from that February peak, again falling. Looks like it's only going to get worse here over the next couple of months as the economy slows down, as the Fed continues to raise rates. We see here in a chart of the S&P 500 and the NASDAQ indexes, both indexes bottomed out there in October and then rose through that rally into late January, early February, but it then crashed since then. So this week I wanted to walk you through 3 reasons stocks will probably keep falling and then discuss my investing strategy to take advantage of these lower prices, really remove a lot of the risk and the stress off of your investing strategy. I pointed out in January that inflation readings would likely start disappointing, with those price pressures just not coming down as quickly as the market expects, certainly not as fast as they were. Here we see the consumer price index, that main CPI inflation report, topped out at 9% in June of last year, started coming down really quickly as a lot of those pandemic problems with supply chains and pandemic problems really started coming out of inflation. Fell quickly until December. December and January really started to level off. So prices, inflation not coming down quite as fast as they had been. And this all came to a head with this month's CPI, PPI, and PCE inflation reports. Those 3 inflation reports that we get every month. CPI, the consumer price index for consumer prices. PPI, the producer price index, what producers and wholesalers are paying, and then that personal consumptions expenditures report. That's the one the Fed watches most closely. It's going to show personal consumptions, consumer spending, a lot of the important inflation readings for the economies. All of those showed inflation much more persistent and really brought back the Fed's need for those higher rates to slow down the economy. In fact, if we look at the chart here, stocks fell 1% or more on each day of those inflation reports this month. Each time those came out, the CPI is usually around the 12th or the 14th, PPI is a couple of days after that, and then the PCE is one of the last days of the month. Here it fell up 1%, about a percent point, 1.05% on Friday of the PCE report. That was last Friday. It was down 1.4% with the PPI report on the 16th, and then it fell 1% intraday after the CPI report came in, before really rebounding a little bit and closing flat on that day. But 1% or more each day of these reports, when they came out, they showed the markets that inflation is no longer falling quite as quickly as expected, and that means the Fed is going to raise rates. Now, even before that PCE report last week, we already had several Fed members talking up the need for even faster rate hikes in the future. Okay, the Fed meets next in March 22nd at its next meeting. Fed members Mester and Bullard before last week were already talking about the need for a 0.5% rate hike. Okay, if you remember, Fed was raising by about 0.5% previously. It slowed down the last couple of meetings to just 0.25% rate hike. The markets loved that. Markets thought, okay, the Fed is slowing down its rate hike. It's going to stop pretty soon, and then eventually it's going to even cut rates. So that's good for the market when the Fed slows down and stops the rate increases. Now we're looking at maybe them even increasing the speed at which they raise rates. And folks, I know this is all a lot of econ talk and talking about the Federal Reserve and all that, but these interest rates, that is the cost of doing business. That is a cost of taking out loans, mortgages, credit card rates, all of these other rates in the economy. The rates you pay, the rates business pay, those are tied to these interest rates. Those are going up. That's going to slow down the economy. And while jobs and consumer spending are still strong, You don't raise rates from zero. They were zero back in about March of last year when the Fed started raising interest rates. You don't raise rates from 0 to 5.5% in a year without seriously hitting the economy. It is the fastest pace the Fed has raised interest rates in more than 40 years. Okay, again, it's the cost of doing business. Investors are still holding out hope that we can do this without a recession, but it's just a pipe dream. So that was the reason one, stocks will likely keep falling. The Fed is nowhere near done raising interest rates. It's going to slow down the economy. We just don't know how fast and how hard it is going to slow down the economy, but it is going to lead us into a recession. Reason number 2 here, I want to look at the FactSet Earnings Insight Report. Comes out every Friday. Great research tool for earnings and that. We are now expecting 3 straight quarters of declines in corporate earnings. You can look through here right now. Companies are reporting their fourth quarter earnings. So the last 3 months of last year, they're reporting what their profits and sales were last year. Right now, average for all the companies in the S&P 500, those largest 500 companies in the United States, booking an earnings decline of 4.8%. So profits in those largest 500 companies in the United States now down 5% on average, year-over-year basis from 2021 to the fourth quarter of 2022. But look at what the expectations here from analysts are. We're expecting 2 more straight quarters of earnings declines. We got 5.7% down in the first quarter. So the January, February, March, when companies start reporting that quarter, going to start happening here in April. They're going to start reporting those earnings. Analysts are expecting it's going to be down 5.7%, another 5.7%. Then in the second quarter, that April, May, June, going to be reported in July and August of the year, companies are expected to report another earnings decline, 3.7%. So we are expecting 3 straight declines of corporate earnings. That is an earnings recession, folks. Right now, earnings for the full year, so 2023, are now expected just 2.2% up to $223. That would be just 2.2% up from the $220 that's expected earnings for 2022. That is still a long shot. Okay, research from Deloitte shows an average earnings decline of around 10% from a recession. Okay, so in a typical recession, corporate earnings typically decline about 10%. That would put the S&P 500 earnings closer to $200 per share this year. So we would have, last year was 220. This year would be closer to about 200. Now, I still think they can get closer to 210 in earnings, but the fact is, folks, we have never increased interest rates this fast or seen unemployment rise as fast as expected without a recession. Okay, we are going to get a recession. We've never done that without seeing a drop in corporate earnings. So it is just delusional that Wall Street and that investors expect corporate earnings to stay flat or even increase just that 2.2% in that kind of environment. Corporate earnings will fall this year. Earnings are the intrinsic value of a stock. That's what you get when you buy a stock. You get future rights to those earnings. And if those earnings go down, then stocks have to go down with it. Reason number 3 here, folks, before we get to that investing strategy, is stocks started higher late last year on just the idea that the Fed would eventually slow down and then stop its interest rate hikes and eventually cut rates to support the economy. But the fact is, if you look at history, the history of bear market crashes, stock crashes, all that into a recession, we have never seen a bear market low. Okay, so stocks have never stopped falling during an interest rate hike cycle until the Fed did stop raising rates. Okay, so I know a lot of investors really bullish, investor sentiment increased, and that started stocks increasing. But the fact is that we've never seen a bear market low until the Fed stopped raising rates, and many bear markets didn't reach their lows until the Fed actually started cutting rates to support the economy. So we are nowhere near the end of this Fed rate hike cycle. Now expecting it to go into at least June and at least another 0.75% interest rate increases, and we could still see lower stock prices. Now, nobody likes listening to a bear, and we all want stocks to go higher, but investors need to face reality and adjust how they invest. Even long-term investors here can benefit from some kind of a shorter-term stock strategy, like I'm going to talk about it. Even if you buy stocks each month without worrying about timing, you might consider keeping those monthly deposits in cash, holding a little bit of cash set aside so you can take advantage of these lower prices as they come. I want to talk through how I'm investing here, really give you some numbers to figure out your own strategy here, take the risk out of the market so you don't have to be worrying every single day if you should invest now or if the market is going to keep falling. Now, we talked previously that the market will probably hit $210 in S&P earnings over this year. Okay, again, market is expected to hit 223. I think that is still a pipe dream. In a recession, earnings are going to drop. I think it gets down to at least $210 in earnings. If we look at the S&P 500 right here, right now, it is at about 3970. That puts us 3970 divided by 210. That puts us at about 18.9, about 19 times on a price to earnings basis. That is not cheap, folks. Even if we get down to like 3,800 divided by that 210 in earnings, that would still only be about 18 times on a price to earnings ratio, and not necessarily cheap. Okay, normally in bull markets, we do get to about 20 or 25 times on that PE ratio, right? The price of stocks versus the earnings they're churning out, or in this case, the index, the entire stock market. But even in this kind of a market situation, in this kind of market environment where stocks are volatile, we're expecting a recession, we're expecting stock prices to continue falling. 18 times isn't necessarily cheap. It would, however, be about 10% down from the recent peak that we hit in January. So I would want to be deploying a little bit of cash. We don't want to sit on our cash too long and miss out on the eventual bull market. So we don't want to try to time the market too long. We just want to keep some of our cash set aside and take advantage as the market comes down a little bit. Now, if the market continued to fall, maybe hitting that 3,500 intraday low there in October, that was the bear market low so far from January of last year, hit about 4,800 at the bull market peak, fell down through to October to about 3,500. If the S&P 500 fell to 3,500 again, that would be 3,500 divided by that 210 in earnings. That would be down to about 16.6 times earnings. Okay, that's getting very close to attractive territory. That would be more attractive. Obviously, I'd probably be using another third of my cash to buy in at these prices, right? I'm not saying that it gets there. I'm going to give you a strategy for if the market doesn't hit these lower prices in a little bit. But if it does get to 3,500, I'm using another third of my cash, putting that to work for me. And finally, if the S&P does fall to 3,250, so 3,250 on the S&P 500, that would take us here to about December of 2019. So erase all of those pandemic gains. Again, a lot of times that's what happens in these bear markets, in these recessions. We erase a lot of those bull market gains. We fall back quite a bit. And so if the market does fall to 3,250 on the S&P 500, we can just do the numbers here. 3,250 divided by those 210 in expected earnings, we're down to about 15.5 times on a PE ratio. That has historically been a great time to invest. That's not saying that the stocks couldn't fall further, but if you can get stocks at 15.5, you're doing pretty good. So I would be deploying the rest of my cash, be fully invested in stocks at that point. Again, this isn't saying that the market won't fall further from that 3,250, but again, that would be 32% drop from last year's bull market peak, a price to earnings point that I would be comfortable with being fully invested. You know, even if stocks fall further, I know that at that PE ratio of about 15.5 times, you know, that's eventually going to rise to 20 or 25 times in the next bull market, and eventually going to make that a great investment, being invested there at that 3250, at that 15.5 times PE ratio. That's going to be about a 50% return if stocks go to that 25 times PE ratio eventually in that next bull market. Of course, I do want to walk through the part of the strategy, what to do if stocks don't continue to fall. I do expect them to hit that 3,800, so that first price point where I would be deploying about a third of my cash. They may not hit that 3,500 level, the prior October low that we hit. If they don't reach that, or if they don't reach that 3,250, what you can do. Now, we should see the economy start slowing considerably here by July or August. Over the next 6 months, we're going to see those interest rate hikes really hit the economy, hit different parts of the economy, raise unemployment. I think that's where you start seeing a lot of investors start realizing that a recession is an inevitability. They're going to start selling off their stocks, and that's when we're going to see the worst of the stock market sell-off over the next 6 months, here through July or August, which would put us right into those second quarter earnings reports. Again, we're expecting first and second quarter earnings to be down on a year-over-year basis. Investors are just going to get tired of seeing the companies they're investing in report lower and lower profits. That's when we're going to see the sell-off. If we do see a sell-off, it's going to be through that July-August period. So this could be the low point for that investor sentiment, and I would be looking to have most of my money invested at that point. I think the Fed starts cutting interest rates somewhere in mid-2024 to support the economy, and then the economy rebounds next year. So I don't want to wait too long. Even if stocks don't fall and I start investing my money, I do want to keep maybe 5% at the least of my money in cash, just for any of those what if scenarios. But if the market hasn't fallen by that July, August period, if it hasn't fallen to reach a lot of these buy points, I would start putting some of that extra cash to work, even if it hasn't reached those buy points. Here I want to talk about some of the stocks that could highlight the week. Another big week for earnings. First up, we have Groupon, ticker GRPN. It's going to report its earnings on Monday, giving the company one last chance to prove it can do something to improve the outlook here. Okay, been investing in Groupon for about a little over a year now. It has done nothing but drop. Company is now valued at just $217 million. That's the market cap of this stock, $217 million. It's basically the value of the private investment they have in a payment startup called SumUp. Okay, a UK payment startup called SumUp. Groupon has about 2.5% stake in that. It's a private company, not listed. That is worth about $217 million. So the market is giving no value assigned to the core business of Groupon. They are burning through cash. They have about $308 million in balance sheet cash. That gives them at least 2 quarters to prove some restructuring efforts have not been wasted. It still only has about $269 million in long-term debt, so a strong balance sheet and some runway for borrowing to extend that period to really get the company back on its feet. The fourth quarter is generally the best for the company, and expectations might be low enough here. We get a surprise upside, so I'm really looking for see what Groupon says about the rest of the year, see what they can do here in this fourth quarter earnings report. We see Target, ticker TGT, reporting its earnings on Tuesday following a disappointing outlook from Walmart during its earnings call last week. Expectations for Target are for profits to fall 56% from a year ago to $1.40 a share, even as revenue is only expected down 1.1%. So I think those earnings expectations are down low enough. Target will beat those in the third quarter report, though. What worries me here about Target is that we saw that Target was suffering more from that consumer pullback versus Walmart. Okay, so Walmart has already said that consumers are spending less. They are prioritizing their basic needs for that spending. And what we've seen here with Target is they don't have quite as strong grocery segment. Target stores obviously do have groceries, but it's not quite as strong as Walmart. Walmart gets about half of its sales from groceries, actually. And for Target, it's only about 17-20%. So Target isn't nearly as focused on its groceries. They also don't have those gasoline stations that Walmart has. So what Walmart is doing, it is bringing shoppers to the store through the gasoline stations, through that grocery segment, bringing them to the store, hoping they spend a little bit more on, maybe some of those discretionary items that are in the store, and that is helping support Walmart. We're not getting that from Target. We saw that in the third quarter, and I'm afraid what it means for the outlook for the rest of the year for Target. Rivian Automotive, ticker RIVN, is going to be reporting its earnings on Tuesday following a disappointing quarter for its rival Lucid Group, that's ticker LCID, last week. And despite these lower prices for electric vehicles, folks, demand growth for electric vehicles could slow this year as consumers just pull back on those major purchases into a recession. I'm not saying that electric vehicle sales are going to drop. They will grow on a year-over-year basis, but just not at the rate that they have been growing over the past few years. Okay, so we are seeing some disappointment and some lower investor sentiment in this group here. Expectations for Rivian are pretty high, with estimates for $747 million in sales, a loss to narrow to $1.94 per share. So investor sentiment clearly negative on these electric vehicle stocks for the moment. C3AI, ticker AI, is going to have to prove its 102% year-to-date rally when it reports earnings on Thursday. Estimates here for the company's loss to widen to 22 cents a share on an 8% drop in revenue to $64 million. With sales growth only expected about 3.4% expected this year, management's going to have to put a very positive spin on that recent AI enthusiasm just to support the shares at these levels. Already trading relatively expensive at 9.5 times on that expected sales. And folks, we've seen these AI shares pop over the last couple of months, shares of all AI stocks, and they're really now having to come out and justify those valuations with a really negative market sentiment. Going to be one of the last weeks for earnings. A lot of earnings coming out this week, really risky around individual companies around those earnings. Investors selling off any company that can't meet its earnings expectations. We do get some important economic data this week, including the Tuesday's Case-Shiller Home Price Index. That's going to show further deceleration in home prices, slowing to under 6.8% over the last year. That's what we saw in the last month. We see manufacturing and services data come out this week as well, likely showing the economy slowing further into a recession. Get special insider access and join the community with the link I'll leave below. Click through and see some of the perks and the extra features you're going to get. Or click through the video on the right for the 7 Dividend Kings to pay your bills in 2023. 7 stocks that have increased their dividend payments for more than 50 plus years. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.